right, I will attempt to bring the same amount of energy as he brings, but very happy to be here today. Have some amazing panelists. We'll jump right into it, so if you guys can just go down the line, give a brief elevator pitch on yourselves and your companies, that'd be great.
Benjamin Quinlan, I'm the CEO and managing partner of Quinlan and Associates. We're a strategic consultancy. We specialize in financial services, work with a lot of blockchain Web3 companies, exchanges, investment platforms, funds. So it's something very dear to me, and we've published extensively on this topic around STOs.
Great, thank you. Great to be back here at WOW Summit. My name is Karena Belin. I'm co-founder of
WHub, the largest scale-up platform here in the region, proudly headquartered in Hong Kong and organizer of major tech conferences. I saw Jane Chan from Invest Hong Kong somewhere in the room. And also co-founder of Angel Hub,
Hong Kong's first SFC-regulated startup investment platform. And I saw Kathy in the room. I do have to make a shameless plug on Web3 Harbor. So very proud founding board member of the Web3 Industry Association here in Hong Kong.
Hi, Jonathan Gill, Senior Tokenization Director and Legal Advisor at Hashkey Group, which is an end-to-end licensed digital assets platform in Singapore, Hong Kong, and Japan. So we're a licensed broker-dealer, exchange, custodian, and an asset manager.
And finally, not excluding myself, so I'm Will Corkin, one of the co-founders of Mantra, which is a L1 chain that's building the infrastructure for RWA tokenization being built on chain, and then also Soma Finance, which is a US licensed broker-dealer, bringing things like public equities on chain, treasuries, all in a non-custodial way. So jumping into the questions, everyone came here for what they saw on the docket, which is, are STOs just a reinterpretation of traditional securities? I think this is about as head-on as a question as it gets, so why don't we start here? Give the people what they want. Whoever wants to jump in first?
In essence, yes. So, I mean, in the purest form of definition, an STO is taking a traditional security, digitalizing it, putting it on the blockchain. So that's really as simple as you can make it. You don't have to over-engineer it too much. The nature of the securities which that can occur with can be anything from equities to mutual funds to real estate is now being explored. So anything that would traditionally be defined as a security in traditional financial world, migrating that to blockchain-enabled issuance and trading is really what forms under the umbrella of an STO. There's a little bit of blurriness around the definitions of that. I mean, there was the big case with Ripple that was going on with the SEC. They were arguing that the Ripple token was in effect a security. I believe the outcome of that was Ripple won. So,
still more or less not.
Yeah.
So they're going to pull that out for as long as possible.
Yeah. So in effect, yes. I mean, there's a lot more to unpack, but yes, that's my short and sweet answer.
Well, yeah, on the one hand side, of course, just to build on, right? We look at securities, so obviously dealing, advising, and running activities in securities do follow under regulated activities. So the regulatory frameworks, and I think that's also one of the question marks, should be the same or
not. They obviously represent ownership, and obviously they also represent certain investor rights, right? In terms of information rights, governance, dividends, etc., etc. But I would argue why put that whole thing on blockchain and leverage technology to just mimic exactly what we already have today. So I'm sure we'll have some more opportunities to talk about the benefits of
tokenizing such securities when it comes to liquidity, when it comes to cost, when it comes to global trade requirements for regulators that they would need to think of. But yeah, so yes and no.
Yeah, I agree, Karena. I think the interesting part, if you look at the definition for the SFC, is they talk about tokenized securities are securities that are traditional financial instruments that are securities, but use DLT in some part of their securities life cycle. So I think, if we look at an STO, you really want to, I mean, for us at Hashkey, when clients approach us and say, we want to list something, you think, well, what does DLT actually bring you? And what sort of advantages are there over a traditional IPO? Because honestly, that's the difference. As in, if your use of blockchain doesn't actually add anything to an IPO, you might as well do an IPO. So all of the clients that we take on purposely bring something else. And I guess we'll get on it.
Yeah, and I think, I mean, it's great points. You know, realistically, just STOs being, you know, security tokens, it means that it is a security. You know, traditional is also something that has kind of been reintroduced or put at the front stage, where, you know, it's just a security. We're just saying traditional because we would need some sort of classification on what's new and what's a bit older. But then looking at, you know, you guys all do and work with kind of different sectors in different areas within the industry. What are the benefits? You know, a lot of people have talked about there's treasuries, there's real estate, public equities, funds. You know, there's a lot of use cases, but what actually makes sense? You know, why even do this?
Well, there's theory and there's practice. So the theory is, well, why are you going to tokenize a traditional security? In essence, you can create divisibility or fractionalization around that security, which obviously lowers the entry barrier for people to trade a particular token. So let's just take an example like a Berkshire Hathaway stock. It's really expensive as a notional price to buy that stock. Maybe, I don't know what it trades at, 300,000 US.
Like half a million.
Oh, $500,000 US. Okay, Mr. Market Watcher.
But you can fractionalize that and allow people to get exposure into that particular security without having to cough up 500,000 for one particular unit of that share. Is that unique to the blockchain world? Not necessarily.
You're seeing fractionalization happen in traditional securities land anyway. A lot of these broker-dealers are coming out and offering that as a capability to lower-end investors or retail investors, so that's not necessarily unique. The other part is, I guess, the trading facilities themselves. You should technically be able to trade these securities 24/7 around the clock. They're not limited in time to what you would have on a normal trading venue or an exchange. And of course, the question is there enough liquidity in these new venues to, you know, facilitate what I would say a healthy or robust trading environment? But I think the real key thing is really around the clearing and settlement. It's the back-end side of the trading activity, because clearing and settlement in markets these days can take anywhere from T+3. In Hong Kong, it's like a T+8, even in the cases of some IPO activity. So being able to do this on a more instantaneous
or real-time basis, it removes a lot of the costs from the actual issuance and trading process. But again, a lot of this is theory. It hasn't really gone to the full extent of any meaningful scale to test it right now. That's
what I'm seeing.
Yeah, absolutely. And I guess it starts arguably, again, with regulations and the regulatory aspects. I think one of the things quite intriguing, because we said, yes, it's very similar because, you know, regulations apply. I think what is still a big question mark is some of real-world assets that get tokenized that before did not fall under, for example, the SFC regulations now, since they are tokenized, potentially would need to be regulated through that. So there's a lot
of stuff that is obviously evolving, and there's a reason why, particularly this year, the SFC has also really, and not only SFC but HKJ as well, declared the tokenization of real-world assets a big major focus areas after first tackling the question about virtual asset trading platforms. I think, yeah, so when we obviously look into, and I probably do have to make a disclaimer, so we're SFC regulated for straight equity investments into scale-ups for professional investors only. And with that, you can see there are a few things we're obviously eyeing
into and are very, very interested in the space, which means does the fact of tokenizing shares allow much better liquidity? Does that enable a secondary market? Can that market be global? Can we have, you know, facilitated cross-border transactions? Also from a cost side, right? Hopefully it will really, really help us in terms of understanding how we structure deals and not need to go through vehicles that not only from the cost
but also the maintenance of these vehicles are quite costly. So there are a few opportunities that are really, really exciting. And last but not least, yes, really on seeing this be integrated in the entire DeFi ecosystem. And also with that, you know, being accessible for retail investors, and with that also, you know, having tackling points of financial inclusion,
which would be really, really exciting to see.
Yeah, for us at HashKey, we look at it from two different angles. One is from the investor perspective, and the other is from an issuer perspective. So from an issuer perspective, as Ben said, the ability to streamline your back office costs is really good. I mean, we have issuers that realize that they don't need to have such large company secretarial departments or investor relations departments, because if the records of transfers are all on chain, or they realize that the dissemination of information can be done much more easily and in an immutable way, that's obviously a huge saving. For an investor perspective, another big benefit is due diligence. If you've ever tried to buy and sell land in Hong Kong, you know that you have to go and do due diligence on paper-based records up to the root title, which is a very long and tedious process. And if paper title is lost or damaged or there's fraud that's occurred, that's a huge pain point. Whereas if you have tokenized all of that and there's one source of truth and it's all digitized and it's very clear, it makes life a lot easier. That's another, we've got clients in the art world, for example, and their biggest problem is fraud. Like our last panelist, how do you actually determine that the Rembrandt that I'm putting in front of you really is a Rembrandt? Now, if it's clear that it's been owned by this person and displayed in this gallery, you can suddenly see the value, and you know exactly the provenance, you know the ownership, you know the price that something's been paid for, so it makes valuation much easier.
Yeah, and I think, brushing upon the real estate side, Hong Kong has, $30 trillion of real estate assets. And it's crazy that, it would still have such antiquated systems as paper. It would seem like a no-brainer. So, obviously working closely with the SFC and kind of either companies and angles and regards, what needs to happen in terms of actually having something that would completely change and pretty much bring to the proper forefront of technology for these markets. So, within real estate or equities, things like this. I think the SFC has done a great job in terms of marketing that they're pro-crypto or pro-blockchain or pro-technology, but still have ways to go. What do you think you would need to see from these regulators to push the needle forward?
You've seen a lot of companies on a regulatory arbitrage binge the past few years with respect to how they construct and operate on a more global level. And I think there's been a lot of skirting around regulations in the Web3 space. Some firms have been a lot more proactive and decided, well, we will get regulated from day one. If you look at the case of something like Hong Kong, OSL put up its hand and said, on the opt-in regulations, we want to be regulated. The key challenge here is that regulatory clarity is important and some convergence for global liquidity. That's critical, but it's all about liquidity. If you want to trade and you want a healthy, robust market, you need enough liquidity for that to make sense. And the reality is a lot of the platforms that can facilitate the issuance and trading of these new securities are alternative style trading systems. They have an ATS license or they're a VATP here in Hong Kong. They don't have enough critical mass of liquidity yet.
All liquidity in the way you do your trades are on traditional stock exchanges. Traditional stock exchanges have, for some time, looked at exploring the ability to move a lot of their systems onto the blockchain. We saw the Australian Stock Exchange try that with its CHESS system, and it was a complete and utter disaster. If you have traditional venues, which are well-liked and trusted, and that's where people trade their securities, migrating towards this digital security enablement, that's going to be a major catalyst towards legitimizing this as these are good and safe venues to trade. It will be difficult for the challengers to really capture a hell of a lot of market share in the meantime, because the institutional flows still require some kind of assurance that this is the right venue to trade in. And if you look at
I guess the securities exchanges around the world, there's only 3 that have the full license like a national stock exchange, and they're all located in free trade zones, like in the Philippines, in Gibraltar, and in Labuan in Malaysia. These aren't known as hot spots for liquidity. So it's all about liquidity, in my view, to make this take off. And I think more regulatory support and legitimacy will make this come to fruition.
Yeah, I would really build on the point on regulations, because I mean we all agree that the problem is not the bottleneck, not the technology. And I think what is interesting, particularly there, is, I mean, change is never really linear.
But particularly here, and it touches a bit on your point on liquidity, we will really see a domino effect on a lot of different regulations that will come into play. So yes, interestingly, we started off, the SEC started off with the virtual asset trading platforms, quickly realizing that you need the entire infrastructure, finance services infrastructure to move, to really unleash all these benefits we're talking about, particularly on liquidity. And things really, really move fast. I don't know who still remembers in this room, in January 2022, that's only a bit more than 2 years ago, a circular went out from the SEC defining virtual assets. And I think everybody who was already in that space probably wanted to jump out of the window because it was so vague and it seemed really, it really seemed like a statement on, okay, look guys, we're never going to look into this, just forget about it. It was really discouraging. But then I think a few months afterwards, I think
OSL got a license, and then remember at FinTech Week back then really a clear statement to say we will be proactively looking into regulating different elements. And we can talk afterwards. It was interesting the order by which, because security tokens actually were much further on the list, that they kind of like came down. And now certain elements of the regulatory framework we're looking in the context of stablecoin, right? And again, something actually we as an industry association in Web3 Harbor really also see our role proactively on giving input and providing feedback on some of the elements that the regulator should really tackle. And these will, be it technology, be it interoperability, be it market infrastructure. I mean, we can go a bit more into detail afterwards. These will be so critical as well when we start thinking about regulating STOs.
Yeah, at HashKey, we're regulated in Japan, Singapore, and Hong Kong. So every day you have clients saying, where should I list my tokens? How should I structure this? Where should I distribute? And every jurisdiction every regulator has its own little quirks. In Hong Kong, for example, you have to have a stable trading history of 12 months for non-security tokens. And 12 months is a long time in crypto, right? Whereas you go to Singapore and you say, we can't advertise DPT services. So you can't put ads in the MRT or on buses and so on. So the regulators need to balance investor protection, which is a noble aim, with fostering innovation. And if you swing too far in either direction, it's not good for anybody.
I mean, do you think we've swung too far in terms of these regulators? I mean, realistically, is it apples to oranges with these different STOs or security tokens should be regulated by something that's completely different from what's been, worked with within the last, let's say, 50 years? Or should they just find ways that there are some nuances with traditional and currently existing laws that this fits into? A lot of them, exactly, 12 months of traditional. If you've left this side and you want to start trading digital assets, then why are you spending 12 months doing that? Or, why would someone give you funds if that's not what your end goal is? So, some of these things just doesn't necessarily make sense. But then even on the US side, for issuing of different digital securities with what we've seen on Soma Finance, it still falls within the private placement ordinance. So, doing a Reg CF or Reg S or Reg D or Reg A, which is what's been happening for the last 50 years, it's just slight different nuances in terms of filings, but it's the exact same process. So it's kind of two ends to the extreme. Where do you think it needs to be, and where do you think it currently is?
I don't think it's swung too far. I think that the regulators focus on regulating the product in the process, but not the technology, which thus far I haven't seen them actively do, which is good, because you don't want to actually regulate the technology or the underlying innovation out of existence. But if it's same risk, same process, same security, then same regulation. I don't see there's any issue with that at all. So, yeah, I mean, that's my 2 cents.
Yeah, I mean, it's always easy to blame the regulators, right? But I think one of the things, obviously, is the questions on speed, right? And obviously, we always want to go faster. But I think what is worse for business is uncertainty, right? And I think, again, I really congratulate Hong Kong on taking a leading role on wanting to drive regulatory transparency and clarity, because we see what it can do. You know, not want to say examples from the US, but obviously we can see that we need that clarity for companies also to build and to feel confident on making that move over. The other thing is, again, when it comes about speed, is obviously regulators also very, very quickly realize, particularly in the blockchain and crypto world, cannot operate in a vacuum, right? So there is a certain alignment on, you know, regional, at least global level. And I think to really orchestrate that is very, very interesting. And we see progress. Of course, we would love to see it even go faster.
Yeah, I think the regulators globally are slowly getting a bit more crypto savvy. You know, in 2019, I remember there was the SFC published a paper and said that anything that's a security token is a complex product, meaning it's unlikely to be understood by retail investors, which, you know, it seemed very draconian at the time. And in 2022, they said, well, actually, we realize now that if something just has a tokenized wrapper and at its core it is just a security, you know, the Christmas present is still a Christmas present. You take off the tokenized wrapper and it's still the same thing. Then you realize that maybe it shouldn't necessarily be a complex product. So you see that they're starting to come to that realization. And as the population becomes more crypto savvy generally, I think you realize that the risk is not actually as high as they think it is. It's easy to make a blanket statement and say, look, nobody can play. It's only for PIs. But it doesn't necessarily mean that PIs know any more or any less than anybody else just because you have a certain dollar value in your bank account. And I think the other thing that we find funny is that the 12-month thing. I mean, just because something's existed for 12 months doesn't mean it's necessarily safe. I mean, it just has to have been sat in somebody's wallet, and you could have had however many bugs in the code, or you can have rug pulls, but if it's somehow staggered over the line of months, then you list it. Which for us, you know, we find very annoying because we have a lot of things waiting in wings. You know, the bursting the 12-month period. But in the meantime, they can say, well, why don't we just do this somewhere else? We'll go to the US, we'll list in an offshore jurisdiction, Singapore, or Dubai, or whatever. And then they can say, we love to have you, but we have to wait 12 months. And it's nothing to do with you.
And just one final thing, I always am very skeptical of any organisation that deals in money that doesn't want to play by any regulations whatsoever. That's never a good sign about the intentions. And we've seen how many scams and frauds and incidences have occurred in this crypto land for a very, very long time. And it keeps happening.
Regulation is not going to regulate this out of existence. Let's be very clear. You always have bad actors. But if you give people a playing field where there is literally no checks and balances to what they do, really bad shit is going to happen. And we've seen it happen time and time and time again. The ironic thing about this space, though, is a lot of the people that are fundamentally so interested in crypto, they're not interested in STOs. They really aren't. They're interested in actually trading and investing in products where spikes in value are correlated to things that they can influence, social media crazes. Securities have an anchor of value, which is very hard to spin 100x multiple on in a month. But people
see this as a possibility within non-regulated crypto tokens, and this is why the flood of interest where so much of that trading activity is taking place is in the non-regulated, non-STO space. A lot of people that want to trade this just trade on something like a Futu and trade regular stocks, and they see it as just good enough for now. So we'll see how that evolves and converges in the coming years.
I totally agree, man. I mean, we are regulated in the jurisdictions we're regulated in because they are financial hubs. You know, we have nothing to hide. It's obviously where we try to get regulated straight away when we enter a new jurisdiction. But a lot of our competitors do get regulated in all sorts of weird and wonderful places. And the question is why. And ironically, a lot of the places, the jurisdictions that marketed themselves as crypto-friendly are the places where there have been the biggest busts. And we now see that, we've always seen regulation as a competitive advantage. I mean, the fact that we are regulated where we're regulated, and we have, the MAS or the SFC or the FCA, looking at what we're doing, should actually give investors quite a lot of confidence.
And so, I mean, do you think that these retail, degens are getting smarter and getting more, open to traditional securities? Obviously the last couple months have seen a big uptick in RWAs, which is real world assets, which is pretty much just the new acronym that people are using instead of STOs now. As there's, a slight more demand for people to, yes, they've maybe made 100x on, Bitcoin or Shad token or whatever it might be. But now they're going, okay, last full cycle, then it went to a crypto winter, we lost 99% of everything. Why don't we try putting that into public equity or a piece of real estate, but without the friction of having to then OTC that crypto into fiat, declare taxes, and then pay for that. Is that the uptick in terms of people looking at STOs?
Yeah, I think it will attract a different kind of investment. I think the core diehard
Crypto fanatics are still looking for the next three-letter acronym to spin a 50 or 100x trade, right? Let's just face it, it's nothing we need to argue incessantly about, because it's very true. I've been around this space so long, and I've seen it again and again and again. So there will be a more sophisticated, digitally savvy, aware group of investors that understands the merit of investing in security tokens vis-a-vis traditional stocks, without any doubt. But there is a cohort of investors that will never touch this stuff because it just fundamentally it won't buy them a Lambo, so to speak, and they can't post it on Instagram. So I'm not saying the whole industry is like that, but there is definitely a cluster that continually reinvent themselves every 6 months with some new term, something, and it's really peculiar. I think this is just one final thing that I want to talk about. Like, there's some anomalies that I think are going to happen in the coming years. So people talk about, I know you mentioned the point about tokenizing a piece of artwork, like a Rembrandt or something. That democratizes access to what is otherwise a very exclusive, an art piece. But I guess the key anomaly here is what is this going to do to the value of these particular assets? Because scarcity drives so much of the value of these assets. As soon as you democratize them, and 1 million people say, I own a fraction of the Mona Lisa, does that fundamentally work in its favor? Or does that actually work against creating a value that people have ascribed to these things for so long? It's just a totally different mindset around how these asset classes will be valued under structures which fundamentally democratize what was traditionally off limits to so many people.
But I think on that point, again, I'm not sure if the question is the right question. Or I would say I would really say it's much more issuer-driven, because even on the tokenization of art, so yeah, the question that is thrown often in the room is like, does a Gen Z want to own
1,000 or 1 million of a Mona Lisa? But I think if you think about what it would unlock in terms of even financing structures for museums and other institutions that could really capitalize on reinventing business models for their own institutions is quite exciting. So again, my short answer would be, I think it will be much more issue-driven. And back to your point
previously on the regulatory aspect, and I think we were talking that as well, is, the regulations do also have, not only the investor protection, but also the issuer protection, right? If it's well done and not overdone, for sure.
Which I think that is interesting. I mean, there are new revenue streams that's going to pop out from tokenization. Things that haven't been able to be unlocked or have been too difficult or just realistically not worth their time to do, because going and doing an offering on, I'm going to do a 1 million shares of a Rembrandt and issue
again,
it.
imagine as a museum you want to buy the next Da Vinci, whatever. I mean, Christie's just sold it off 1 or 2 years ago. But if you really you want to think about a museum being able to access that and then allow their regular visitors to help them purchase it, because they would own a fraction of it, and with that get free ticket rights, get probably incentivized on people they bring into the museum. I mean, that's super, super exciting.
Yeah, I think you've got a point with the collectibles. I mean, that actual client, we had a guy who said, I've got a $70 million US Mark Rothko painting, and if I want to sell it, But if I go and do that, my options are Christie's or they're Sotheby's. And there's only a sort of pool, a very small pool of people who would actually have 70 million cash ready to go to buy my painting. If I can fractionalize that, you know, I know I can access a much larger pool of people. So I take your point about scarcity value, but I think that it is an issuer-driven market. And if issuers think that I can get a price premium by fractionalizing something, it's a bit like your Berkshire Hathaway shares. More people can participate. That would arguably drive the price up rather than down, thinking, well, everybody can get a piece of it.
It's very, very early days. Very keen to see how that evolves in terms of price discovery. But to answer your question, will this attract a certain group of investors? Without any doubt, we haven't mentioned it, the institutional investors. This is what they care about. Institutions haven't flooded into traditional crypto markets for a very long time. They've been skirting around the sidelines. Fiduciary duties mean it's very difficult for them to take a punt on, you know, traditional crypto assets, because how do you explain that to your end investor when you have no foundation to justify the value which you want in?
It's a fiduciary responsibility. But now, if you can tokenize assets which they have long invested in as asset classes that they understand, but now you're providing wrappers and benefits that STOs bring, this makes a lot of sense for the institutional world. So STOs, in my view, are really about unlocking institutional capital into this space, which is otherwise being parked on the sidelines, only
to a very minimal extent moving into the Web3 space.
So, you know, on that side, it's one thing that we've touched upon, you know, kind of a number of times has been the liquidity. Obviously, institutions coming in has brought an immense amount of liquidity into the space. 2 weeks ago, you had, I think, $630 million flow into the Bitcoin ETFs within a single day, which was the most amount of capital injected into the space pretty much since its inception. That's what's pretty much been bringing the market up, is obviously now institutions getting access to it. But across the board, liquidity is the biggest issue. You know, Ben, you've mentioned it multiple times on this panel and previously. You know, obviously you can tokenize a piece of real estate or a building, but that's an illiquid asset. You know, it's not like someone's going and trading that, or you have a high frequency guy going and trading that. That's just, you know, maybe solving a couple different problems in terms of, you know, land registry and, you know, whatever else. So with this in mind, I mean, what would be the securities or the assets or, you know, potential revenue streams that would solve the side in terms of liquidity? Besides institutions, you know, what are some securities that you think would be the big things that would unlock people going, you know what, that makes sense. I'm going to come into this and I'm going to invest into this.
Okay, I don't think it's necessarily a type of security. I mean, for us, we always look at the tokenomics behind it. You know, like right now I'm working on a construction company that wants to tokenize future income streams. And the reason what they're actually trying to do is they're attaching oracles to their machines. So on site, you've got, across Hong Kong, you've got 100 bulldozers. And all these bulldozers, like say this one's working at this site for this long and earning this amount of money. I mean, that level of granularity is something that you previously would never have had. You know, you just have to say, take a month, and if I'm buying a share that this construction company is doing this job, and maybe once a year you have an AGM, you can earnings update or something like that. But you don't really know. It's just trust me, trust management. Look at my financial statements and that's it. Whereas your ability to see these things in real time is amazing. And the management actually came to us and said, we want to show investors how good a job we're doing, like how hard we're spending our assets, how productive we're being. The changes that we've made, like the machines that we've got, are attached to data oracles. So people know exactly how much more productive we are and why our CapEx is worth it. And that's something that previously you'd never have had.
Yeah, so the crystal ball question, right? I would, nobody knows. I mean, I would love to see, obviously, tokenization of equity.
For me, I think it's going to probably be more in the areas like private equity and venture capital, stuff where there's long lock-in periods, significant institutional interest. There is a patchy liquid market in terms of people coming in and out, but it works in big blocks and it works in big chunks of time. I think if you can create liquidity around that space for more institutional and high net worth investors to trade in and out of these structures, that I'm probably a little bit more bullish on.
Yeah, and I think, I mean, just closing it off, maybe on a bit more of a retail side, and that everyone's mentioned in different ways is different revenue streams and new revenue streams. I think that ultimately the technology is what it involves. Whether it's a recording artist or a Twitch streamer or someone that's going on and making things but needs money to create the next show. I think these are potentially new avenues, new ways for people to make money and to invest in things that actually mean something to them instead of Berkshire Hathaway because we've heard of Warren Buffett, but otherwise we don't know what they do. But I want one whole share.